Hello everyone. I'm Shivang Mehta. In this video, we are going to analyze JM Corporate Bond Fund and open-ended fund scheme, predominantly investing in AA plus and above rated corporate bonds. So we are going to technically analyze and suggest that who should invest in this scheme. Let's go ahead. First of all, let's know about the company. GM Financial is an integrated and diversified financial service group. The group's primary business include investment bank, mortgage lending, alternate and distressed credit, and asset management, wealth management, and security business. That is platform AWS. This is the main financial services business of the GM Financial. About the scheme and objectives. So scheme is an open-ended debt scheme predominantly investing in AA plus and above rated corporate bonds. Investment objective to generate income through investing predominantly in AA plus and above rated corporate bonds while maintaining an optimum balance of yield, safety, and liquidity. Investors are required to read all schemes related documents. To before investing, they should analyze their risk appetite and the yields they are expecting from the scheme. Asset allocation pattern of the scheme. So asset allocation of the scheme will be divided into two parts: debt and money market. Up to 100% of the asset under management of the scheme can be invested in debt and money market instruments. Risk profile of this instrument is low to medium, while up to 10% can be invested in investment fund, REITs, and investment trusts. So their risk profile is quite high. So only 10% will be allocated to that. Medium to high is the risk profile. The scheme shall has exposure to corporate bonds with AA plus or equivalent ratings and above credit ratings, at least to the extent of 80% of the corpus. So 80% of the corpus will be at least be invested in AA plus credit rating bonds and other securities. How will scheme benchmark itself and who manages it? So benchmark index of the scheme is CRISIL Corporate Bond Index. So it will give a right comparative analysis of the scheme's performance of over the years, and the fund will be managed by Ms. Shalini Tibberwala and Mr. Vikas Agrawal. They are highly experienced investment bankers and they are with GM Financial for a long time, so they will be managing this scheme. Investment details. So as we know, the official name of the scheme is GM Corporate Bond Fund. Minimum investment required is rupees 5,000 and further in multiples of 5,000. Additional investment amount is rupees 1,000 in multiples of any amount thereafter. There are two types of plans: regular and direct. In growth options, growth, income distribution, come capital withdrawal. These are types of plan depending upon the money requirements of your financial plan. So default plan will be direct if you invest. Default option will be growth, and exit load will be 0.5% if redeemed within 180 days. So 0.5% you have to lose if you redeem it in within 130 days. Lock-in period is nil and redemption time is T plus 1 business days. Basic details of the scheme. Issue will open on 24th Feb. Issue closes on 7th March. Category is debt corporate bond. Type is open-ended. So you can withdraw anytime. Minimum investment 5,000. Lock-in period not applicable. Exit load is 0.5%. Risk meter moderate. So people with moderate risk appetite can invest in this fund. And as we know, benchmark is CRISIL Corporate Bond Fund. Investment strategy. The scheme aims to generate income predominantly investing in AA plus and above rated bonds. The scheme shall endeavor to develop a well diversified portfolio of debt and other instruments. The scheme may also invest in the scheme of mutual funds. Scheme may also invest in hybrid securities, which is real estate trusts and investment trusts for diversification and subject to necessary stipulations by SEBI from time to time. So an effort will be made, to diversify in debt instruments as much as possible to reduce risk and uh, increase yields from the fund. So this will be the main investment strategy of the fund. pros of investing in this fund. So risk of pandemic hampering growth of company has reduced. So new credit cycle has started and pandemic has reduced its impacts all over the world. So company shutting down and revenues, wiping off, that risks can be are avoidable, you know, avoidable in considering the risk. New credit cycle upside is seen in corporate borrowing with growth in revenue and consumption in country. So new credit cycle has started in the country post pandemic. Government is pushing corporates for capital investment. So government is also providing, schemes for capital investment in the companies through PLI scheme and other schemes. New real estate upcycle is ongoing in countries, especially in housing market, which might lead to increase in corporate borrowing. So due to reduced interest rate, a new real estate housing market upcycle has started, which will lead to increase in borrowing over the time. And due to lower interest rate, defaults of the payment will reduce. So that will, maintain the credit rating in coming years. So who should invest in this NFO? This is the main question. So the people who needs income in short to medium term and to generate capital appreciation through investment in predominantly AA plus and above rated funds, investors should consult their financial advisors if doubt about whether the product is suitable for them or not. And investment should, understand their risk appetite before investing with this scheme. Risk appetite should be moderate. They should be ready to, take little losses if possible, to be with this scheme. But uh, people with high risk appetite or very low risk appetite are not advisable to invest in this scheme. Thank you.